Hi, today we're going to talk about financial literacy. Personal finance and financial literacy is nothing but knowing how to keep what you earn and do more with what you keep. It is the financial literacy. It is understanding how you can build your personal wealth. What is financial independence? What do you mean by financial literate? What is wealth? Where does your money come from? Look at this illustration, the cash flow quadrant. There are four ways that money may come your way. First, works for somebody else or have an occupation. Work for yourself if you're self-employed. Then go into business and make your money work for you. So you can see the arrows, which are options on how to earn money. Again, work somebody else, go into business, make your money work for you or work for yourself. Then, where does your money go? If you have money, where do you spend those? First, account payable savings. Then, for support for parents or relatives. Then, the most important one, for your child's education. Invest the education of your child or children. That is the most important. Then, the very common household expenses, the different household expenses. For example, for buying food, groceries, clothes for your children, and for other needs. Then insurance premiums and the others. Then for your luxury or your uh, if you want to go to a mall to buy something or to eat in a restaurant or anything. So those are the different um, thing where we put or use our money or our income. But facing the realities, this vicious cycle of poverty. For example, daily wages earner or low and irregular income of some people. Social obligations in spite of less money. Unforeseen requirements like sudden illness and other difficulties in our lives. Then borrowing at higher interest rates and mortgaging assets. Then emergencies like natural calamities like floods, flash floods, earthquakes, or volcanic eruptions, which pulls down our economy or our lives, which gives us difficulties and blows our earnings or our savings away. Then where are you now? Uh, to know where are you now or where your money are going, you or we should plan our personal financial statement or statement of assets and liabilities. So to know where your money goes. Financial planning. It is the benefits of having a sound financial plan. So it can help you avoid mistakes or sidetracks. It also helps you make smarter decisions. It can insulate you from the turbulence in the economy, and it makes money work for you. Income expenditures can be classified as follows. First, consumption, protection, savings, and taxes. The cash flow gain. So it shows here the income, the expenses, the assets, and liabilities. So if we have a job or passion, you will get income. Then when you have money, you will use it in different expenses for your assets. The liabilities also included. So let's talk about now financial life phase. For number one, start up. Number two, you should build up. Then number three, fine tuning. And number four, retirement. Where are you now? Where do you want to be in the future? So that is the big question that only you can answer. Simple rules in financial freedom. Rule number one, pay yourself first. You is your first source of capital, the savings. So let's talk about saving. Save money for your future. Do not uh, put expenses or do not use money in not important one. So we should know how to save properly. Redefining savings. So it must be defined as expense. It is an expense that buys your future. Savings is a conscious and deliberate way of setting aside a portion of the personal income. So portion of your income, so you have to save it, just a portion, just to save a little to make it big. Equation. So Y for income, C consumption, and S for savings. So rule number two, we have define your financial target at each life phase. So life cycle events, first, the house, clothing, and food, which is very essential, the marriage of your children, the maternity, education for children, business equipment, rescue mortgage, if you want to buy a new house, or accident, which is um, accidentally comes on our way, pilgrimage, working capital, festivals, loss because of floods, riots, or cyclone, extend house, or even death. So those are the different life cycle events. Rules in setting goals. Put it into writing. State it in positive terms. Set a specific timetable for each goal and monitor progress. Obstacles to savings. First, procrastination or the delaying savings or putting savings off for another time. Then second one, poor spending habits. It includes spending on unnecessary items or impulse buying and hedonistic lifestyle. So those are the obstacles to save money. The third one, the culture of dependency. Being overly dependent on others. It means depending on your relatives who supports you financially. Then lack of financial literacy. Spending on liabilities or items that increase in value over time, decrease in value over time, or not knowing how your money will grow or work for you. The culture of dependency. And rule number three, stop spending on things that diminish in value. Know the difference between assets and liabilities, the needs and the wants. Poor spending habits, impulse buying, and too much entertainment. Yes, know the difference between your needs and your wants. Know the things that you really need and you only want. Rule number four, protect your greatest income generating asset yourself. Or alert number one, health is wealth, as we always says. Health and protection are very much interrelated. If you are not healthy and you not take care of yourself, you can get sick, meet an accident, get disabled, or die. God helps only those who help themselves. So this is a common sayings. If you help yourself to be prosper, to be successful, then God will help you or support you, and other people will support you also. Rule number 5, grow with the economy and beat inflation. So here an illustrative formula of 80 over 20. So 5% for set aside or put aside a portion of your saving for emergency. 5% for general savings, for savings or for your daily needs in buying food or anything else. Then 10% invest or build asset base. And the remaining 80% uh, in your needs or in clearing debts. Rule number 6, trust the power of time and compounding. For period 1, period 2, period 3. So for example, your money will double because of interest earning, then it will be tripled and so on. So power of compounding, so this is an example of illustration or table. Year, principal, we have 1,000, simple interest for 100, total, when you add, so principal, compound interest, and total. So end of 10-year, for example, here you will save 2,594. So this is example of compounding or how to make money compound or power compounding. So rule of 72. For example, you are being invited to invest in a financial transaction that offers a 20% return per year. But before entering in any investment, be sure that they are genuine or legit. Okay. Inflation is the economic condition of sustained price increases. Money is an asset that continuously loses its value. Rule of 72. On the other hand, if you want to double your money in 3 years, at what rate of return should you invest your money? Simply divide 72 by the number of years within which you would want to double your money, or 3 years, and you will get the required rate of return to double your money. So example, number of years 72 over 3 years equals to 24%. Rule number 7, assess risk and option. Note, the higher the risk, the higher the return. Always investigate first before believing. So again, before you invest, think and don't trust easily. When do banks or lenders lend? The ability of borrower to prove that he will use the proceeds of the loan in activity that will produce sufficient income to repay or repay the loan. The borrower has more than enough sustainable income to pay for the loan plus interest, because there's always an interest in every loan. Then the lender does not mind foreclosing on for or talking over the collateral. Then rule number 8, we have make money for you, the power of leverage. Borrowing, leverage in finance, or analyzing good debt. Then people leverage. Investment, so here we are. Investment is the commitment of funds made in expectation of some positive rate of return. If the statement is properly undertaken, the return will be commensurate with the risk it assumes. Invest and diversify. Invest. Make your money grow. Invest your savings in money-making assets. So take a risk in making your money grow or in investing. When buying real estate property, do a canvas on the location first, where the area, the total cost. Make sure the property you're buying is properly titled and has no claimants. It means clean title other than the owner. Get a document, legal document, to be sure that this is legit. Investing in your own business. Remember that not everyone has what it takes to run a successful business. If you think that you have what it takes to become a successful business person, then it's time to plan your business. Think about what business you can engage in. Look around you and identify business. Do a situational analysis. Identify the strengths, the weaknesses, the opportunities, and threats to your proposed business. And for negative mindsets that we should avoid, for example, the things about I do not have enough money, or I do not have good enough ideas, or you're distrusting people, or fear of failure. Make use of the power of one's strength in numbers. Saving together provides more and varied opportunities to earn higher returns as well as secure better benefits of all. Cooperatives are a good way to avail of the power of many. Determination, discipline, and decisiveness. Learning to say no is part of discipline. In good or bad times, never give up. Remember, winning is a habit and make it yours. So, I'm leaving you these sayings by Ruth Smoltzer. You have not lived a perfect day, even though you have earned your money, unless you have done something for someone who will never be able to repair you. So that's all, and thank you.